Hey, I'm Brennan Young in the tax group here at Mayor Brown. I regularly work with the capital markets group on a variety of capital markets transactions. You clicked on this link because you're interested in hearing a brief presentation about the recently or relatively recently enacted stock buyback excise tax. That was in the Inflation Reduction Act of 2002. Came out about August, so we're going to go briefly over the rules for that, and then we're also going to talk about a recent IRS notice that has a little bit of guidance about that, and what's going to kind of come after that notice. So let's start with just the general. What is the stock buyback excise tax? This is a non-deductible 1% tax on the value of a stock of a covered corporation, which we'll get to in a second, that is repurchased by the corporation or its affiliates during a taxable year. What is a covered corporation? Generally, that is a stock of a U.S. corporation. In some cases, it can cover buybacks of the stock of a non-U.S., so a foreign corporation, where that stock is purchased by its U.S. affiliate. That rule took effect, so the new law took effect in 2023, and there was no grandfathering rule. So if you had some outstanding preferred stock or something like that, for example, that you had issued in 2021 and you want to do a buyback of it in 2023, it's still captured. There was no grandfather. And the tax generally applies to anything that's defined as a redemption under the code, which is pretty broadly defined. It can pick up a lot of different things. So let's talk about the exceptions. So we know that there's a 1% excise tax when you buy back your stock. Well, let's talk about the big exceptions to the rule. The first big exception is it only applies this excise tax to the fair market value of the net stock repurchased. So if you do some redemptions of a U.S. corporation, and then you also issue more shares, you would net the two, as long as those two things happen during the same taxable year. That's kind of the key. So if you do a stock issuance in 2023 and a buyback in 2024, you're not netting those. It's only the same taxable year. Another exception is for stock buybacks that do not exceed $1 million. So if for the whole taxable year, you only did $1 million worth, you're not going to be covered. If a buyback is part of a tax-free reorganization, like a recapitalization where you exchange one class of preferred for another, that's generally not covered. Repurchases by REITs and regulated investment companies, RICs, we call them in tax, a little acronym. Those are not covered. So the next exception is any redemption that is treated as a dividend for U.S. tax purposes. As with a lot of things in the U.S. tax law, that is relatively complicated. In this micro talk, we don't really have time to get into the details on when something is or is not a dividend for U.S. tax. But just know that's an exception if it is treated as a dividend. And then finally, if the repurchased stock is contributed to an employee benefit plan, that's also going to be an exception. Under regulations that we don't have yet, there's going to be rules for when a repurchase is done by a securities dealer in the ordinary course of their business. This notice does touch on that a little bit, but that's still to come. So then let's talk about the most recent update here, and that is Notice 2023-2. It was issued at the end of 2022, so I think it was actually like December 29th. And the IRS has a tendency lately to give us a nice big piece of guidance right before New Year's Eve, which is always delightful. And let's talk about what the notice does. So everyone was a little bit panicked about this excise tax, and that's because it affected a lot of different types of transactions. It covers private and public U.S. stock. It's unclear how it applies to, for example, SPACs, which we know there are a lot of out there. And so people worried about it. They pleaded the IRS for guidance. They issued this notice. It's a temporary piece of guidance. So basically, the notice announces that there's going to be proposed regulations, and it provides a bunch of guidance in there that's probably going to ultimately end up in the proposed regulations. So it's kind of like a preview of the proposed regulations. It does a few things. So it generally excludes distributions that are in complete liquidation. This was a big one for SPACs because a SPAC is generally set up to raise a bunch of money and then go find a target. If it doesn't find a target during its window, then the SPAC will just wind up, so it'll liquidate and everybody gets their money back. It wasn't exactly clear that buyback, so the liquidation, was going to be excluded from this excise tax, which would obviously be devastating, because then you're talking about raising $1,000 and then sending out, 1% less. There is an exception in the notice, and it'll probably end up in the proposed regulations for repurchases that are in complete liquidation. And then it does a couple of other things. It provides a few transactions that are economically similar to the types of transactions that are accepted from the rule. So if you're in one of those, the rule might not apply to you. And then the notice also provides a lot of technical clarifications on a number of aspects of the excise tax, such as the timing and the valuation of repurchased stock, the application of the netting rule to employee comp plans, reporting rules for the excise tax, and then a little bit of an expansion of this this net for public non-U.S. companies using a domestic or a U.S. subsidiary to repurchase stock. It has like a per se rule. So looking ahead, the question is going to be, will the proposed regulations exactly match the notice, or people that might comment on the notice, will those comments be taken into account in the proposed regulations? Once we actually get the proposed regulations, there'll be another notice and comment period where taxpayers can ask for the provisions to be amended if there's some things that are either unfavorable or unfair, or some situations that just aren't covered. And then the latest update, this is as of last week, is the president's revenue proposal and the corresponding green book, which is like a treasury explanation sort of the revenue proposals, includes a proposal to increase the stock buyback excise tax to 4%. Unclear at the moment exactly how realistic of a chance that is. So for more information on this particular topic, obviously I've covered it at a very high level here since we're doing a micro talk. We do have client alerts out both on the legislation and on the notice. And then just for more capital markets updates in general, please check out our free writings and perspectives blog, where we update regularly on any developments going on in the capital markets world. Thank you for your time.